Welcome back to the show this morning. It is 6:34 as we get your Wednesday up and running. And, we talked about yesterday about this issue of, the rise of socialism in the economy. And, of course, Bernie Sanders has re-entered the 2020 race. This has to do with Illinois, so just bear with me for 1 second. I'm getting there. But it was interesting because, Bernie Sanders thrown his hat into the ring, of course, to run for president. And again, you shouldn't dismiss that so very easily and just say, it's Bernie. He's crazy old Bernie. He ran last time, didn't win. He almost won the primary. It was neck and neck between him and Hillary Clinton. So don't dismiss Bernie Sanders altogether. There is a rising tide in this country about socialist ideas. Elizabeth Warren has just come out and talked about imposing higher taxes on the wealthy to pay for universal child care. So, this idea of paying for all this stuff, regardless of what the consequences are, is one of the underlying factors because of kind of where the economy's headed. And one of the things that we've discussed is the unsustainability of this rise in debt. And we've talked about the flaws with modern monetary theory, which is Ocasio-Cortez's idea about how to pay for everything. We'll just print money and, issue debt. And it's, debt and deficits are no problem until nobody wants your currency anymore. Then it becomes a problem. So Illinois, though, is an interesting test tube for one of the biggest crises that is potentially facing the United States over the course of the next several years. And, there's a lot of individuals who say, well, we're never going to have another financial crisis again because, the mortgage crisis, the subprime mortgages, that was a one-time thing, and probably true in regards to another crisis relating around mortgages. Changes have been done. A lot of the crazy mortgages we were doing back prior to 2008, we're not doing those anymore. It's a good thing. But don't mistake that there's still a lot of people buying houses that they can't afford. That hasn't changed. Take a look at what's happening in house prices out in California and other places, and we're starting to see some of the impacts of that. But that's not really the issue. See, every crisis that happens throughout time, whether it was the dot-com bubble or whether it was a financial crisis or it was portfolio insurance in 1987 or we can go back through every one in history, right? We can go back to 1929, the big crash in 1929. That was because banks were both the brokerage firm and the bank. And the bank was lending money to investors to buy stock in companies that the banks were taking public. And so they were just all leveraging themselves up. And, of course, when the bubble popped in 1929, well, you know what happened next. Now, what's interesting is that that's when we established the SEC. Following the demise of the markets and the economy in 1929, 1931, 1932. In 1933, we passed the acts to establish the SEC to have some regulatory oversight of what banks and the combined bank brokerage firm idea was doing, right? And then we passed an act in 1940 to separate banks and brokerages and say, you two can't play well together. There's too much intermingling when you have banks and brokerage firms being the same entity. So we separated them and said, y'all can't play together. Y'all have to you have to pick it. You can either be a bank or a brokerage firm. Well, in 1999, we repealed Glass-Steagall and stuck them all back together again. And then 7 years later, we blow up the entire world as we know it because banks and brokerage firms were playing together again and they were intermingling and doing all kinds of naughty stuff they shouldn't have been doing and blew up the financial system. So we still haven't fixed that problem. That's still a problem that we haven't fixed yet. But the mortgage issue is probably not going to be the next big issue. One of the big issues, it's a $5 trillion problem, and it's pensions. There used to be a time in history where you went to work for a company and the company gave you a pension, and you had a pension that the company funded. And that pension was invested in treasury bonds. That was it. And it's very safe, it's very stable, and the interest rate that was being paid on the treasuries was an easy calculation. Look, I have this much money invested in U.S. treasuries. They pay me 5% a year. Over the next 30 years, I've got this much liability coming down the road. And they knew exactly how much money they had to have invested in the pension plan to meet obligations of retirees down the road. It was a very safe structure. Well, then along comes 401k plans, which transferred this idea that said, hey, you know what? As a company, I don't have to mess with this anymore. I don't have to use my profits to give to my employees. That's just stupid. Why would I do that? When I can just put the entire burden of saving for retirement on the employee. They'll do it. I'll give them a little bit of money. I'll match them 3% of what they contribute. If they don't contribute, no big deal. I don't know anything. And of course, that's exactly what happens here. Only 1/4 of all employees in the country actually contribute to a 401k plan. Only 1/4. It's pretty sad. But regardless, then banks, then these companies said, you know what else is that we need a higher rate of return, because if we can get a higher rate of return, if we can get 7 or 8% a year, which is what the market was doing back in the 80s and the 90s, then we can contribute even less, right? We're only getting this piddly 5% interest on treasuries, but if I could get 8 or 9% from the market, I can contribute even less of my profits to the pension plan, and these stocks will just grow up over time and meet my obligations. Well, that never happened. So they had these 7% annualized rates of returns that never happened, and so pension funds got behind the curve during the crash of 2001 and 2. When the markets recovered, they never got back to where they needed to be on a funded status to meet their obligations. And remember, the workforce is getting older as we go along. And the baby boomers are heading towards retirement as we go along over this time frame. But after the dot-com crash, well, they were underfunded, but they said, okay, no problem. We still got 7% rates of return. We're going to get a rally in the market. We're going to recover on this. And we got back to even in the markets in 2008. And yet pension funds were still grossly underfunded, and retirees are now 8 years closer to retirement, and then the market crashes in 2008, and pension funds get decimated. So now they're even more underfunded. Retirees are now older, heading into retirement, getting there. And so finally the markets have recovered back over the course of the last 10 years, and yet pension funds are still banking on these 7% rates of return. They're even more underfunded than they were previously because of 2 crashes. And the problem now is that all these individuals are getting ready to retire, right? The demands for the pension fund, that 30-year window that pension funds had to grow their assets, is now here. We're now up to the point where retirees are starting to roll off the rolls, and they're starting to say, hey, I would like my pension, please. So the demands on pension funds, and we just here in Houston, we just had a big vote last year on getting, we issued debt to put money into the pension plan to try to shore up some of the unfunded liability problem. And Illinois, Illinois is probably one of the worst funded pension plans in the country, but all pension plans, for the most part, are vastly underfunded relative to the obligations they have down the road. And one of the big issues here is, and what Illinois has decided to do is that, and you should be afraid of this, by the way, Governor Pritzker's administration has now made clear it will seriously consider the latest idea to address Illinois' pension crisis, transferring public assets directly to the state pension. It announced the formation of a task force on the subject. At its core, the concept is extremely simple. The problem is that it's exceptionally subject to smoke and mirrors, because it's going to further kind of obfuscate the pension system that's already, really far too opaque the way it is. And these asset transfers really do nothing to improve the state's overall financial health. All you're doing is just shifting assets around balance sheets at this point, but you're not solving the state's, really big deficit problem that Illinois has in particular. But this is not, Illinois, while Illinois is the case for one of the worst funded pensions in America, it is symptomatic of what's happened across all pensions in America. And the biggest problem here is that now we have baby boomers on the verge of retirement, You've got a $5 trillion shortfall in pension funds. And when you have the next recession and market downturn, you're going to be able to drive a hole through the through the status of these underfunded pensions. And at some point, these baby boomers on the verge of retirement are going to say, you know what? I better retire right now. Otherwise, I'm not going to get my pension. And if you have a run on the pensions, that's one of the catalysts for the next major financial crisis in this country, because somebody's going to have to bail them out, and that somebody is going to be you through taxes. Don't go away.
Want a longer talk with Lance about your money? Request a personal one-on-one at lancerobertshow.com.